Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Netflix reported earnings after the market closed on Tuesday, and there were some really interesting insights from the company. Now, Netflix isn't a stock that I own, but it is related to a number of other companies in the media landscape. Companies like Disney, Time Warner, Discovery, Comcast, which owns NBC Universal. So I think this is an interesting one to cover, and some of the big trends that I pulled out from this earnings report, especially to see if they're going to continue with some of these other media companies. So that's what I want to dig into today. My name is Travis William. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my content. So let's dig into the earnings report to start. And I'll start here at the top of the report because there's some interesting numbers to begin with. One, they start talking about their advertising products and how well that's going, particularly in the US, and how they're upgrading. That I'm going to dig into a little bit more as we go through this, but that I think is really the big change over the last year at Netflix. This is a company that wouldn't do advertising for the longest time, and now it's gotten into the advertising business, and it's made the company a lot more profitable really quickly. Here's the baseline numbers. So revenue was up 3.7%, not a ton of growth. Subscriber growth was up 4.9%. So that looks like that revenue per subscriber is starting to come down. That has a lot to do with things like foreign currency and where subscribers growth is happening. Operating margin made a huge turnaround from 7% a quarter ago to 21%. And as you can see, free cash flow, this is one of the companies that's going to be able to turn their business and say, you know what, we're going to focus on cash flow, and it's going to happen really, really quickly. We saw that in the first quarter, up to over $2 billion of free cash flow for the quarter. So that's really impressive. Overall, I think the trend here is that the top line and the subscriber numbers are just going to slowly but steadily increase. It's not going to be the kind of growth that we've seen for a long time for Netflix, just simply because they're at an incredible scale. 233 million global paid subscribers. There's a cap on how many they're going to be able to grow to. I don't know if that number is 500 million or a billion, but they're just not going to be able to keep doubling all the time. So expect that growth number to slow from a revenue perspective. But the bottom line is really where we're going to want to see some improvement. And that's where we're seeing great results, helped by advertising. And that's what I really want to highlight here. Management said we've seen very little switching from our standard and premium plans. So basically, the ad tier is just additive to the business overall. It's also going so well that they're launching programmatic private marketplace to enable more buying for advertisers on Netflix using Microsoft's ad platform. Microsoft, you might remember, is the ad platform that Netflix is actually using to serve up those ads. They didn't build that out themselves, but it allowed them to grow extremely quickly. And then right here, this is the biggest thing. Ad plans already have a total average revenue per month greater than that of standard plans. In other words, a small subscription fee plus advertising is going to total more revenue for Netflix than consumers that are just paying for their monthly fee. As a result, the company said that it would increase the ad plan profile from 720p to 1080p and introduce it in more and more markets. The great news for Netflix here is that they're going to be able to grow their market in two different ways by adding advertising to the mix. They're going to be able to serve more customers because they're going to have more price options for those customers that may be priced out at something like a $15 or $20 per month fee, but they're going to be able to get in at a much lower entry point, and then you're just going to get served up ads. So you broaden the base. The other thing is they're increasing the amount of revenue per customer, and that's explicitly what they said here, is that advertising is actually making up for a loss in subscriber fees, more than making up for it. I think at the end of the day, what this is going to mean is Netflix is going to move further and further into advertising. I wouldn't be surprised if eventually we see a little bit of advertising in all of their tiers. That's something that we're starting to see Disney move towards as well. That's the other thing that I want to take away from this is we've seen Disney also move into advertising. They took a little bit different structure. Instead of saying we're going to offer a lower price tier with advertising, they said we're going to raise our prices and we're going to add an ad tier if you want to have the same $8 per month price. But I think in both cases, what you're going to see is revenue per subscriber in margins or cash flows increases. Now, Disney's in a little bit different situation because it's losing a lot more money on the streaming business than Netflix was. Number of years behind in a lot of ways, doesn't have the same base. But if the economics are getting better for these companies that do reach scale, that could actually create a nice moat for them. They could have a big profitable business, as some of these other companies struggle. And I think at the end of the day, that's where we're going to get with the streaming business. There's going to be a small handful of companies, probably Netflix, Disney, and I would say Time Warner Discovery is going to be the other one that's going to eventually be a player here. They're going to dominate the streaming space. And the other companies that have streaming services now are going to be falling by the wayside because it's too costly to keep these networks operating. And the services that have hundreds of millions of users like this are better for advertisers as well, because they can just place one ad and serve a whole bunch of countries and reach tens of millions of customers. So this quarter was just great news for Netflix, and I think that extends to the other eventual winners in streaming. Disney, like I said, I think is a logical winner, and then probably Time Warner Discovery. But we're starting to see this streaming business mature extremely quickly. They've cut back spending extremely quickly. Look for that to be something that happens probably across the board for the industry, and that means cash flow is going to go up. So from an economic standpoint, these businesses look like they're in better shape today than they have been at any time in the last few years. But I'd love to hear your thoughts on Netflix earnings report. Just came out. I will put a link to that in the show notes as well if you want to look at that. Don't forget to subscribe to Rive Investing for all my content. Thanks for watching, everybody. I'll see you here next time.